Hello, my name is Gene Vollucci. I wrote the book, How to Buy and Sell Apartment Buildings. Today I'm going to talk about how to buy mid-size apartments. We bought and sold over 10,000 units, and I'll give you some of the highlights, and hopefully you'll learn a lot from this session. I really didn't make my money in real estate. I'd like to go ahead and relate a little story to you before we get started on how I really made my money. When I graduated from college, I went to work for a Fortune 500 company as a junior accountant in the accounts payable department. There I learned how to pay bills the Fortune 500 way. We used to go ahead and pay our bills based on 210 net 30. Means if you pay your bills within 10 days, you can take a 2% discount, but you must pay them in 30 days. Well, the Fortune 500 company that I worked for used to pay them in 60, 90, 120 days, float the money, earn the interest, and still take the discount. And I guess might makes right when you're dealing with a Fortune 500 company. After about a year and a half, 2 years, close to 2 years, I got another promotion to this Fortune 500 company as a junior accountant in the accounts receivable. We used to bill our clients 210 net 30. If they paid within the 10 days, took the 2% discount, there was no problem. But if they paid after the 10 days and tried to take the discount, I would have to bill them back. And some of the smaller clients, I would have to take them to small claims court to go ahead and collect the money. I guess what's good for the goose is not good for the gander in Fortune 500 companies. I got another promotion after about a year. It was a junior accountant in the general ledger department. I was working there really hard, preparing budgets and credits and debits and all kinds of financial statements. And a beautiful young lady came to work as a bookkeeper. Her desk was near the water cooler. So I sloshed around the office for the longest time, finally got up enough courage to ask her for a date. We started dating quite regularly at the time, and then I finally got another bit of courage, and then I asked her to marry me, and she accepted. We set the wedding date for that spring. It wasn't until the day of the wedding that I found out that her father owned the company, and that's how I became wealthy. Seriously, I earned it the hard way. I worked hard for it. I literally prepared thousands of tax returns. When you see that much confidential information, you get a pretty good idea of those people who are making money and those people who are saving money on their taxes. Today I'd like to go ahead and go through some of the strategies that are in my book, How to Buy and Sell Apartment Buildings. And I'd like to also dispel some of the myths that are involved, some of the roadblocks that people have when they're investing in all types of real estate. One of the biggest myths and one of the biggest roadblocks that people have when they're investing in real estate is the myth, and you'll be surprised to hear this, the myth called cash flow. If you think you can become wealthy with cash flow, you might as well be straightening up the deck chairs of the Titanic. It ain't going to happen. The way you become wealthy in real estate is through appreciation. If you go to a potential seller or real estate broker and ask that person, what's the cash flow for this apartment building? You're putting the proverbial cart in front of the horse. You should go ahead and have some idea of what the potential appreciation should be for a particular location, a particular apartment building. And this is where this seminar today will come in handy. The other myth that's involved is location, location, location. Problem with location, it looks too much like local, and a lot of investors start investing locally within a 20 or 30 mile radius of where they live. You can't or you should not invest locally if there's no appreciation or anticipated appreciation. The third myth is tax benefits. Tax benefits are the second most important reason why you should be investing in income property. Tax benefits are such that if you go ahead and structure your transaction wisely, you'll have Uncle Sam paying for your investment. I'll show you how to go ahead in the seminar to get up to a $25,000 write-off from tax and tax savings for self-employment taxes and self-employment income and earnings, W-2 earnings. It's right off the top. So if you're investing in real estate, make sure you're buying in pockets of opportunity, and these are areas that will appreciate. Also make sure that you don't put the cart in front of the horse, that you're investing for appreciation, not income. If you're wealthy, cash flow is important. If you're wealthy, you can become wealthier. But to attain that certain level of wealth, you should go ahead and work with appreciation and structure your transaction so you'll get the highest tax write-off. That way Uncle Sam will go ahead and pay for your investment. Let me tell you a little bit about apartment industry. It is a $4.6 trillion industry. About 25 to 30% of all apartment buildings turn over each and every year. So there are constant opportunities. There's a book put out by Harry Dent. It's called The Roaring 2000s. If you don't have it, I would suggest that you get it. There's a part in that book that talks about supply and demand. Supply and demand are two of the important factors of whatever type of investment that you're doing. The supply of rental property over the last 10, 15 years has been somewhere around 200,000 units. The demand, however, has been somewhere around 400,000 units. You can see the demand is greatly outstripping the supply. The other thing about demand is that, according to Harry Dent, the greatest number of echo boomers, these are children of baby boomers, will be entering in the next 8 to 10 years, will be entering the rental market, which will increase the demand substantially. So basically on supply and demand, the economics of supply and demand, what will be happening is that the supply will continue to decrease on a per capita basis, and the demand will increase substantially. So even if you make some minor mistakes in real estate to get into rental property, that's 5 units and greater, get into rental property, income producing property now will be a wonderful investment. Let's talk a little bit about the types of properties that our organization invests in. The properties that we invest in is called mid-size apartments. Mid-size apartments have some unique features to it. Mid-size apartments, based on where you're investing in the northeastern part of the country, it's somewhere between 50 and 70 units. Southwestern part, Florida, in that area, it's somewhere between 60 and 100 units. Midwest, it's between 100 and 150 units. Northwest, Washington, Oregon, somewhere around 50 to 60 units. Southwest, California, Arizona, New Mexico, and Nevada, somewhere in the 40 to 60 unit range. This is what we considered mid-size apartments. Why mid-size apartments? Because of something called pure leverage. Let me give you an example of pure leverage. Let's say you have $5,000 to invest and you want to buy $10,000 worth of stock in .com company. So you go to the stockbroker and say, look, I want $10,000 of .com company, but I only have $5,000. Your stockbroker will say, give me the $5,000, I'll sell you the other $5,000 on margin. Let's say you have $5,000 that you want to invest in a $10,000 apartment building. So you go ahead and go to your mortgage broker, or you go to your real estate broker and say, I want to buy this $10,000 apartment building, but I only have $5,000. And your mortgage broker says, give me the $5,000, I'll sell you the other on a mortgage. So on one side of this example, on pure leverage, you have mortgage on one side and margin on the other side. Are we all singing from the same hymn book? Very good. Let's say you go into your office and your $10,000 of .com company suddenly goes up to $15,000. After a month, it goes up to $20,000. Then it goes up to $40,000. You go drive into work, go into your cubicle, and you're happy as a clown. All of a sudden, your coworker comes to you and says, have you heard the latest? And you say, no. So the CEO of .com company has just been hauled out in handcuffs for insider trading. Can that happen? Yes, it happens too often. So you go back into your cubicle and you look into your monitor, TV, and look at Financial News Network or some type of market program. and you find out that your $6,000 investment, or your $40,000 investment early that morning is now only worth $7,000. Your telephone rings, you pick it up. How many people believe your mother's on the other line inviting you over for cookies and milk? Who's on the other line is your stockbroker. He's asking for a margin call. Margin call sounds a lot better than cash, doesn't it? I have a friend who's invested in the stock market, and ever since he's invested in the stock market, he says he sleeps like a baby. He gets up in the middle of the night and he cries. Let's talk about your apartment building 10,000. Let's say your apartment building suddenly has some damage, whether it's storm damage or earthquake damage, and you try to get out there, but it's all cordoned off by the police and you can't get in. So what happens, you later find out that the damage wasn't that extensive and that through governmental financing, hopefully, you'll go ahead and get it fixed. So your telephone rings, you pick it up. It's not going to be your mortgage broker asking for a mortgage call. It'll probably be your mother inviting you over for cookies and milk. And why is that important with pure leverage? Is because it allows you to ride up the peaks and the troughs of your investment so that you can hold on for better times. Whereas the stock market, sometimes within a matter of hours, you're wiped out. So pure leverage is very important in real estate, all real estate. The other thing that's important with real estate, is, mid-size apartments, primarily is economy of size or economy of scale. Let's say you have a 4-unit building and you have one vacancy. What's the vacancy factor? 25%, that's correct. If you have a 40-unit building and one vacancy, what's the vacancy factor? 2.5. Economy of scale. Let's say you want to carpet the 4-unit building and the 40-unit building. What will have the highest per square foot cost? It'll be the 4-unit building, not the 40. Economy of scale or economy of size allows you to break those chains of local investing so that you can invest anywhere in this country and anywhere in the world that has what? Cash flow? No. That has the most appreciation, pockets of opportunity. The other reason that we pick mid-sized apartments over the 10,000 plus that we bought and sold is because of diversification. We can diversify based on the number of properties that we have available, whether it's a duplex or a triplex. We can diversify into a 40 or 50 unit building for economy of size. The other thing about diversification is that we can diversify by investing in areas that will appreciate different parts of this country. It gives you that additional edge, diversification. The other reason that we invest in mid-size apartments because of appreciation. Mid-size apartments have had the highest appreciation over the last 20 years than any other type of real estate assets. This is not my projection, it's the projection of the National Council of Real Estate Fiduciaries. It has had, using leverage, average annual appreciation for apartment buildings, 5 units and greater, using leverage at 25%, the annual rate of return is 24.5% over the last 24 years. Those figures will get me on the dance floor to do the jig and do a lot of other things. Let me tell you a little bit about the Center for Real Estate Studies. It comes under the umbrella of Cal State Companies. And if you want to know more about Cal State Companies, it's calstatecompanies.com on our website. We are a research and educational institution. I teach classes in colleges and universities on investing in real estate. We have what's called an econometric model that makes a 2-year projection on 175 cities across the nation as what their potential profitability will be. Actually, it gives you 3 buy and sell recommendations each quarter. It's a quarterly publications. It gives you a 2-year head start on where you should be buying, where you should be selling. It's a fantastic publication. It comes under the Center of Real Estate Studies, and also under Cal State Companies we are a real estate firm, and we also have an investment firm. Also we have a membership of over 1,000 club members, and we're quoted in leading publications, the Wall Street Journal, a lot of the apartment house associations. I do seminars for a number of apartment house associations. We provide the resources and support so people or members with a little amount of money or capital can earn substantial profits. They can get into some of the apartment buildings for as little as $25,000. We're committed to our members' success, and we have a proven track record. We have on the chart, you will notice that Dallas shows a rate of return, a buy and sell recommendations in that area. And if you go ahead, and these figures are based on IREM, the Institute of Real Estate Management, and that's the annual rate of return after taxes. There are some areas in the country that do not have that type of rate of return, and you can see the various rates of return on various buy and sell recommendations that we made through market cycles. Our book is titled 3 Moves to a Million. Part of the subtitle, or our seminars are titled 3 Moves to a Million, How to Buy and Sell Apartment Buildings, 3 Moves to a Million. In that book, we show how 3 moves, 3 different locations, someone starting out with $6,000 can earn over $1 million. The first move was to Phoenix, and the reason we moved to Phoenix is based on our market cycles that told us that that area would have the greatest appreciation. We stayed there in 5 years, and then we moved on to Boston. We stayed in Boston 2 years. Market cycles indicated that was another area that would have a greater appreciation, and that was Seattle, Washington. We had 10 people to start off with, each with $6,000. We had $60,000, and they parlayed it from the first move one from Phoenix. 5 people went into the second move, which was in the Boston, and 1 individual went into Seattle, and that 1 individual, starting with $6,000, was able to parlay it. 10-year period of time. The overnight success took 10 years, but they were able to parlay it into over $1 million by location, 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 / appreciation, appreciation, appreciation. These figures are taken from IREM, the Institute of Real Estate Management, as to what the square foot cost, selling costs are, and on various other statistics. And you'll find that in the book, How to Buy and Sell Apartment Buildings. The latest edition has been out for about 1.5 years, 2 years, and that you can get it in all bookstores. How do we know when to buy and where to buy, when to sell and where to sell? Well, we've identified in market cycles, quarterly publication, market cycles, we've identified 5 phases of an apartment's cycle, the regular bell curve. The 5 phases, excuse me, the 5 phases of an apartment cycle are: phase 1 is the recovery phase, and that's when things are looking up, interest rates are acceptable, employment is high. It's not the McDonald's hamburger jobs that we concentrate on. It's the McDonald's / Boeing jobs that we look at. Rents are starting to go up, and in that particular economy, everything is looking rosy at that phase 1. Phase 2 is called peaking. That's phase 2, and everything in phase 2 on the bell means that rents are increasing on a decreasing rate, but they're increasing. Prices are increasing at a decreasing rate. The bell's starting to curve. About that time, you'll start seeing sticks go up, builders starting to building apartment buildings. Vacancies are still low. The next phase is called the boom phase, or phase 3. And that's when supply is equal to demand. That's when the rents are flat, prices are flat, and that's when a lot of inventory is basically coming online. instead of having a line of people wanting to rent your unit, you might have to wait a few weeks to go ahead and rent it. That's the boom phase. The third phase is called a recession, and that's when prices are decreasing at an increasing rate. Rents are decreasing at an increasing rate. Unemployment is high, inflation is high, and things are kind of looking gloomy. And that's when you see NODs, that's the notices of default, being filed by the lenders, mortgage brokers, during phase 3, recession. The last phase is called bottom fishing, and that's when things are in the doldrums. The NODs end up on the courthouse steps, people are doubling up, landlords, owners are offering 6 months free rent, trip around the world in a toaster just to go ahead and rent it for a few months. Things are very bleak. What will happen on this bell curve on the phase 5? It'll start again on phase 1 when the local politicians decide to do what? Create jobs. Jobs are the engine that drives all economies. Soon as jobs are starting to create, you'll start to go in phase 1. Let me ask you a couple of questions here. If you were going to buy a piece of property, how many people would buy it in phase 1, phase 2, phase 3, phase 4, phase 5? In our quarterly newsletter, Market Cycles, we generally recommend, and this is the 3, we make 3 recommendations for buy and 3 recommendations for sell. We recommend that you buy it in phase 5. The reason we recommend you buy it in phase 5, not only will you get the best price, but you will get the best terms. And what are the best terms for buying? Basically, no money down. But we never buy for our members, no money down. We use leverage wisely. We don't buy in foreclosures or no money down because there are certain, in the book you'll find out there are a number of pitfalls to buying foreclosures. So in phase 5 you can buy with very little down, using it wisely, and you can also get the best price, negotiate the best price. Okay, let me see the hands, or let me go ahead and see how many people will go ahead and sell in phase 1, phase 2, phase 3, phase 4, phase 5. If you put your hand up for phase 3, you are the greedy ones. And I'll come back to that in just a minute. We usually recommend in phase 2, and the reason we recommend in phase 2 is that you might not get the best price, but you can get the best terms. And getting the best terms means generally all cash, not only for tax purposes, but for commitment purposes. Because if you sell in phase 3 and have to carry back paper, you have a commitment or you have a liability on that particular property if your name is recorded on the title report. If the buyer is sued, usually the attorneys look at everybody's name on the title report, and if your name is on the title report as an individual carrying back a second trust deed, there's a possibility that you might also get sued. Phase 3 is you might get the best price, but you won't get the best terms in phase 3. Let me tell you a little story about phase 3. We had bought some property in Southern California, and we decided, against Market Cycles advice, to sell it in phase 3. We got greedy. 6 months after we sold it, we're in Southern California, we had an earthquake. And the earthquake affected this property that we sold. When we sold it, we took back a $150,000 second trust deed. So the buyer came to us after a month or 2 and said because they had damage on that property, they couldn't pay on the second trust deed, and they asked us if we would defer the payment for a few months. Being the good guys that we are, we said yes. About 6 or 7 months after that, we got a call from the first trust deed holder, and they said, you know, the guy that you sold that property to a few months ago has not been paying on the first. Well, that's interesting. I said he's not paying on the second either. What he was doing, it's called milking the property. He was collecting the rents, not paying the utilities, some of the utilities, not paying the taxes and not paying the mortgages. We had to step in there. We had $150,000 at stake, and if we didn't get it resolved, we're going to lose our whole $150,000. So I contacted some of our professionals, some of our associates. I've been in the real estate business for over 35 years, and one individual indicated that they would go ahead and bail us out. They would make the first current, they would pay the taxes, the utilities, and do some repair. However, on our second trust deed of $150,000, they asked for a little discount. Now, little is kind of like a relative term, isn't it, when you're talking about little? So I said, friend, he's still a friend by the way, how much of a discount do you want on the $150,000 second trust deed? Guess what he said? He said he wanted a $75,000 discount. So we sold it in phase 3, but we had to take a $75,000 hit on the note that we carried back. It's not a problem to go ahead and carry back second trust deeds, but be careful of the economics involved. When you're buying rental property, mid-size apartments, you have the ability to hire people that will help you. It's building a winning team that we call it, and getting people that know what they're doing to help you will increase your chances of making money. You don't have to go through a steep learning curve that causes you a big problem, cost and time. And you don't have to kick the tires because the people that you hire are individuals that are trained in rental property, investment properties. And the two people that we work with mostly with our group of investors are CCIMs, that is Certified Commercial Investment Members. You can find them on the internet at ccim.com. These are qualified individuals. They have the designation that indicate they will help you invest in real estate and give you good advice. The other individual or groups that we work with is CPMs. It's Certified Property Managers. And these individuals are local CPMs. They also have a designation that tells you that they have the experience and the education to give you good advice on buying. So when we put small groups together, we work with CCIMs and CPMs exclusively. After you've located the area, you got your team together, you want to analyze property. I look at a multitude of property setup sheets or information sheets each week. They're all painting Monets of the property, but a lot of them are Donald Duck cartoons. So we analyze the property using these two tools. The first tool that we use is IRR after taxes. That's the internal rate of return after taxes. It gives you an idea of if you presently buy a property and sell it in the future, what the actual rate of return is based on the present value of inflation. So it gives us a true picture of what we made on the investment. So we use IRR AT after taxes for evaluating income property. The other tool that we use is called a cap rate or capitalization rate. That is the net operating income over the purchase price. And the cap rate that we use on real figures is 8.5 or greater. And the cap rate goes something like this. The lower the cap rate, the higher you pay for the property, purchase price. The higher the cap rate, the lower the purchase price. So if you're buying property in a 4, 3 or 4 or 5 cap rate, you're paying a great deal for that property. Try to look for property that has an 8 cap rate or better. There are variations to that, and it's mentioned in the book, but try to go ahead and work with a cap rate. There are a number of ways to go ahead and evaluate property, but we find that the internal rate of return and the cap rate are two most significant ones, and ones that we can rely on. Well, what do we do for our members? How is it important to them? Well, for our members, we have bi-monthly meetings. We also have reports that come out on a monthly basis to our members. And in our bi-monthly meetings, we usually have it on the weekend, and it's a 2.5 hour meeting. First part of the meeting, we have an educational meeting where we have professionals in the real estate industry, attorneys, CPAs, people, mortgage brokers, people that give our members who attend the meetings a wide scope education on what's happening in the real estate industry. The second part of our meeting is called the property presentation meeting, and it's only available to our members. In the property presentation meeting, we present properties to our members who are interested in buying as a TIC, a tenant in common. I'll go through that in a little while. We present a full package property presentation meeting. We have pictures of the property. For example, this picture is a property in Houston, Texas called Pecan Shadows, and the price is $4.2 million. And individuals can get into these properties. In fact, we bought 12 properties in Houston. We bought a number of properties in Southern California, Nevada, Denver. These are pockets of opportunity. I mentioned Houston, Austin, Texas, Phoenix, Arizona. We bought a number of properties in the $30,000 range, $29,000 to $30,000 range, and we sold them to California investors back east for the $60,000, $65,000 range. So these are presented at the second part of the property presentation meeting. Individuals can ask questions. The meetings are taped so that if anyone can't attend, we'll send them a meeting and the complete property presentation package so they can go ahead and call our offices and ask questions about it. If they're interested in buying a 5 or 10 or 15% interest, they simply fill out the paperwork just the same as buying a property on your own, 100%. No different. You put your money in with an attorney or escrow, get all the due diligence reports. We have a physical due diligence report from Criterion that gives us all the information we want to know about a particular property. We also have a financial due diligence by a CCIM, gives us the financial information. After they receive all this financial information, the individual investor can go forward with the purchase, or they can go ahead and bow out. So they can go ahead and do their own due diligence. We'll provide information for them so that they can make the right decision. And that's how people starting with a nominal amount of cash can get started in multifamily properties in pockets of opportunity. And it's only available to our investors. So that is the meeting, the property presentation meeting. Very important. We presented 18 properties last year. We're hoping this year to present a lot more. Let me mention why I think we're successful. We don't charge any syndication fee at all. We're real estate brokers, and we get a real estate broker fee from the seller. We are co-buyers in these properties. We put our own money into these properties. We don't get an equity interest like a lot of syndicators do by not putting any money. We put our hard-earned dollars into these properties. We look primarily for appreciation. The first year or two, there's very little cash flow, if any, but we go ahead and fund for that. Syndicators, private syndicators, look for cash flow. They put 50, 60% down. The internal rate of return after taxes is dismal. The other thing, we work for appreciation. Our property's been appreciating over 20% per year. Commercial syndicators look for cash flow. Cash flow has a better ring to it, but you don't really make your money in cash flow. You make your money in appreciation. We put our small groups together, usually 8 to 10 people, form a TIC, which is Tenant in Common Group. That's how we put our groups together and raise capital. And the TIC is a very important concept, a very important way to own property. And we've been using it for over 20 years. But with a TIC, you have complete flexibility. You can put it into a trust. You can go ahead and, as far as taxes are concerned, you don't have to take depreciation. You can go ahead and adjust your percent ownership in taxes the best way that suits you. So we go with a TIC agreement, a 12-page agreement that each one of the co-owners sign. The other way, you have to be careful when you're in a group, any group, to have the protection. The TIC gives you, the tenant in common gives you that protection. Number one, your name is on the trust deed, which gives a good indication that you are our owner, especially for financial purposes. The other protection that we have is that we have cover adequate insurance. We've had slip and falls from pregnant people, but we've never taken a penny out of our pocket for any liability insurance. The other wall of protection that we have is that we ask, you don't have to do it, that we asked each one of our co-owners to quit claim their portion of their ownership into what's called an LLC, which is a limited liability company. And we recommend Nevada for various reasons as far as asset protection is concerned. So you have TIC, which can be used in a trust. It can also be used with IRAs. There's a way to go ahead and use your IRA to go ahead and get into some of these investments as a member. So TICs are very important for protection, flexibility, and as far as tax planning is concerned. Once you have this together, then we negotiate. And we negotiate for the group. We pretty well have poll them and find out what they want, and we negotiate for the group. I teach negotiations. There's two important terms that you should be aware of. One is that price is inversely related to terms. If your seller is asking for his or her price, then you want terms. It means that you want the seller to carry back paper. The other concept that you should be aware of is called appearing to be the least motivated. When you're buying a piece of property, you tell the seller, look, if I can't buy your property, I've got a half a dozen other properties that I'm going to buy. Or if you're a seller, say, I don't want to go ahead and accept this particular price because I got a lot of other offers and your price is extremely low. It's called real estate poker. And if you've ever watched the World Poker Tour, you get an idea of body language and being the least motivated to go ahead and sell or buy, appearing to be the least motivated. There's an old saying in real estate poker, and it goes something like this. Does everybody know what a Smith & Wesson is? Yes, it's a gun. And the saying goes something like this. A Smith & Wesson beats 5 aces hands down all the time. That is real motivation. So be careful when you're negotiating. Look at body language. Look at the world of poker and see what they do for body language. And try not to be too anxious to buy or sell. The second most important reason that you should buy real estate is for tax savings. Because like I said, the government helps you pay for your investment. The two areas that give you the biggest write-off, not garden hoses or office in the home or mileage or any of these other ding-dong deductions that people come up with when I'm doing their taxes. The two biggest deductions are depreciation and interest. Now you can expand or increase the depreciation by doing what's called a component depreciation. And criterion that when they do the physical due diligence, they break down the property into various components that's acceptable by the IRS. For example, depreciation on land is how much? If you said 27.5 years, you're wrong. Building, residential income, there's no depreciation on land. Building is 27.5 years. That's a long time to write off an asset. And you get very little depreciation every year. So you try to allocate as little as possible to the building, and you allocate as much as possible to personal property, such as garbage disposals, carpets, drapes, things that will depreciate in 5 to 7 years. The shorter the years in depreciation, the more you can depreciate each year. The more you can depreciate in each year, the greater your tax write-off, the greater your tax savings, the greater your internal rate of return after taxes. The second biggest item as far as write-off is interest. You can adjust interest by increasing points and reducing the interest rate and reducing the number of years. There are various ways to go ahead and do that, to go ahead and write off the points. For example, if you're paying 10 points over 3 years, which is a lot of points, but maybe the interest rate's lower, you can depreciate those points over 3 years, which gives you a big write-off, and the internal rate of return will be a lot higher. There are many more strategies that we give in our meetings, in our educational meetings to our members. So be careful, try to get the maximum depreciation as rapidly as possible, because you don't know what the IRS is going to do from year to year. And it's best to take advantage of the write-offs when they're available rather than wait. Because I've seen over the years, thousands of returns that I've done, that you might wait for a better time, and that time may never come, believe me. So we got our tax savings, we structured it, we negotiated, we got the best price, we got small groups, 6, 8 people together, and we buy the property. We would hope that when we put a group together, that the individuals would go ahead and look at the property before they put their stamp of approval and go forward with it. But that's not always possible, because people don't have the time to go ahead and do it. Plus, they may not have the expertise to do it. And this is what we teach them in our seminars. So what we do is, after the property is purchased, we would hope that the individuals would do a physical inspection. We also, when we put a group together, we have monthly reports, accounting reports, operating statement reports. There are several reports that were required by our SOP, Standard Operating Procedure. And also we have a number of telephone conferences. People are learning throughout the year. We have email. We do physical inspections through email. In fact, after the property is purchased and you can do a physical inspection, we would hope that you would go ahead and do it. In fact, we bought property in Las Vegas that some of our co-owners used to go up there 7, 8, 9, 10 times a year to look at their property. I think it was all legitimate if they looked at the property. So remember this, that mid-size apartments are the wave of the future. I think you can make a lot of money, fewer headaches, especially if you do not completely know about investing in mid-size apartments and running a property. We will go ahead and teach you. You'll learn throughout the years, so that hopefully that you can go ahead and do it on your own. The last thing I'd like to go ahead and talk about is working through Learning Annex. We've made our membership program available to everyone. The membership generally runs around $1,300, but we made it available to our Learning Annex subscribers or people who look at the seminar for $495. What you get is a year subscription to Market Cycle. You get some special reports that go out through the year. You get the book, How to Buy and Sell Apartment Buildings. I'll go ahead and autograph it for you. You get 3 research reports on taxes, on marketing, and on comparing the stock market with the apartment market. The membership includes access to our properties, educational seminars, networking. We have over 1,000 people, and support. You'll get our complete support. So it's a money-back guarantee. If you're not happy with it, you get to keep the reports and go ahead and send the rest of the package back, and we'll go ahead and cheerfully refund your money. All you have to do is go by the directions of Learning Annex. I think they take various credit cards, and if we run out of kits, well, we won't run out of kits. I'll make sure that we won't run out of kits. I'd like to go ahead and thank you for your time and your patience. I'd like to leave you with this one thought. Yesterday is history. Tomorrow is a mystery. Today is a gift. And that's why they call it the present. So make a present of this membership. I am sure that you'll be happy you did. Thank you very much for your time.